Good morning, ladies and gentlemen. Well, the risk dial keeps on getting more and more negative, and in my experience, when it does that, it just means that more and more of the spreads it looks at are going negative. And because of this score, it's going to take absolute months for it to go into risk on again, a long, long time. So you're still looking for levels to sell equities and buy bonds, and I'll go deeper into that because next week we have the QRA, and that could change things substantially. It's unlikely to, but it could. So let's have a look at the last QRA. So on Monday we get the announcement of how much they need to refund, and on Wednesday we get the table like we got last quarter. As you can see, the recommendation, the provisional indication for the next refunding, i.e. this one, is exactly the same as the one before, and therefore the odds that they change it are not great. This really will be the first refunding that Besant can do something about the structure of the issuance. Really, the last one, he'd just come into office literally a couple of days earlier, so it was unrealistic to expect anything. The reason why it's unrealistic to expect anything at this refunding is because, let's face it, the market is not in a good place. So if I was in his shoes, this is certainly not the refunding that I would choose to bring in a radical change, because the market is really going to find it very, very difficult to absorb extra issuance of duration. But what they could do, and this would be a little bit of a surprise, is do a mini operation twist, i.e. increase the Yellen effect, as it were. How would they do that? Well, they would do that by increasing the size of the off-the-runs they buy and not increasing the size of the 10s and 30s. So let's say they increase the size of the off-the-run buybacks by, I don't know, 2, 3, 4, 5, 10 billion, and they don't increase the corresponding size of the issuance. That means that they're actually net buying duration, because they will be funding the purchases presumably via bills, and therefore that would actually flatten the curve, because the market would know that they're going to be buying off the run 10s and off the run 30s, probably that what they'll be buying actually is 20s. That is what makes sense. But if they don't increase the size of the 10s, 20s and 30s, then actually they're buying back duration from the secondary market. And that would be a mini operation twist, which actually flattens the curve. No point in thinking about it at the moment. It will be announced, and as soon as it's announced, we will be able to react. But I just wanted you to be aware that that is something that they could do while maintaining the mask that they're not doing anything. And if anybody asks, the explanation is simple. Well, the spreads are very wide. We want to bring in the spreads. This is not anything that we think is, sort of damaging to the market. No, it's not that we want to flatten the curve. This is purely technical, etc. But the effect will still be the same. The effect will be that they flatten the curve, because if they're buying off the run 20s, 25 years, 17 years, 15 years, and funding it with bills, then they're going to be flattening the curve. So let's have a look at something like 2s, 20s, which is the most likely area that they would buy back, right? Because those are old 30s, old 20s, that kind of stuff is what they would be buying back. And really there is room for them to push it to around minus 80, or even these levels minus 72 without the market having done, so without changing the structure of the long-term steepening. It's just a very short-term reaction. And that is what I would look for if he were to do that. I have no idea if he will. I'm just aware of the possibility that he could do it. And the risk reward is not bad to go into it slightly long of 220s, because I think that the market reaction to an unchanged would not be to really steepen the curve. It would just be, just a good risk reward to have a flyer that he does it, because if he does do it, we go, 15, 20 basis points, and if he doesn't do it, we go 2, 3, 4, 5 against. So risk reward is there for a move back to these levels, and that changes nothing in the overall steepening. 2s10s, what would that do? Well, it would go back to minus 42 or something like that, and again, it changes nothing in the overall steepening. I just want you to be aware of them. So what do I think about bonds? I think they're not worth trading at these levels. I don't see anything that is really that exciting. I think the twos are stuck for the time being in a very narrow range between 370 and 390 until we get data. Let's face it, the tariffs came in on April the 2nd. People were shocked. They took at least 1 or 2 weeks to see what they can do about it. And if they're going to start firing people and not importing and not having economic activity, that data will be reflected sometime in, mid to late May or early June, because that will reflect the decisions they made after the announcement of the tariffs on April the 2nd. So I think it's too early for the twos to go, simply because we need time to get that data. So anything that you see up here is probably an excellent opportunity to buy calls on the futures, because at some stage when the data comes out, I would really expect, if the data is what I expect it to be, that we start breaking these levels. We break 344, we're going to go straight down to 285. That's the kind of thing that I expect to happen eventually, but certainly not next week. Why will that happen? I keep on saying it. The Fed is very cognizant that when data comes out showing the weakness in the economy, hard data, they will be behind the curve. They will know that whatever they do, they should have already done. And therefore, they will not move 25s, they will move by 50s or larger. And you will get much bigger moves at the short end than you will get at the long end. And that is the definition of a steepening. So if next week we get a little bit of flattening because of a mini operation twist, as I've been describing, that is actually a longer term opportunity to go against it, if you believe that the data will roll over. And I do believe that the data will roll over. So 2s and 5s next week, I expect to have very little movement, basically staying at 382 to 406 kind of range, and then slowly over the course of the next couple of weeks to be prepared to start breaking down. 5s, I think, over the course of the next month will trade at these levels down here, ready to break down and go at least to 268, 269. That is my longer term prediction for what this market is getting ready to do, regardless of whether they do a mini operation twist next week and the 10s and 30s do slightly better. What can the 10s do? Well, they can come down to this kind of level, 413, 415. 30s, they can come down to something like here, 462. but I don't think that they are ready. The 10s and 30s are ready to break down in anything like the same way as the 2s and 5s are. And that's why I keep on saying you either have, the steepener on or you're flat. You can definitely trade, as I described, for a small amount of flattening, 5, 10 basis points, but you just cannot have a flattener on unless you believe that this economy is about to start roaring again. In Germany, and this is 2s, 10s, I see much less of a steepening opportunity because the market has done so much. Look, we got to the levels that I thought we would get to, and that is about it. I think now it's far more likely to correct and do something like this than just keep on going straight through. So I think there's very little to do in the German yield curve unless we see minus 53, minus 54, which I think next week we are extremely unlikely to. What do I think about the bonds? Well, I think that they are probably stuck now for a considerable period of time. They've managed to, gain back everything there, and I just can't see them making new highs right now, but I can see them making new highs on the move much later on in the year if it proves that the German economy and the European economy overall are much less affected by the tariffs than the US economy. So that would be a spread between Germany and the US rather than an outright Bund move. This was puzzling to me. I never thought it would get through here, but it has, and therefore you have to respect it, and you have to say that the market is negating that we're going to get a very big move in Germany outright back to those monthly 365s that I thought. It just isn't going to happen for the time being because the market is too uncertain as to what the results will be of the tariff talks, and it's going to take time for the market to decide. I would leave the bunds well alone. I think, though, that if you see this kind of level, for whatever reason, I can't imagine why they would come down to the 220s. That would be too much of a steepening or even a flattening the other way. So we're looking for this 238 to 235 area. I think is a great area to buy put spreads again. So I'll have that on my playing card. 235, 238. That's probably another 100, 150 ticks. And then I think the odds really are that we return upwards to at least the 257 area. So that is what I have on my card for next week. The main reason why I don't think bunds are going to make big moves is because the Italian bond is so well bid and so quiet. We are at levels that just show how quiet the market is and what it's actually doing. It's just picking up the higher yield of the Italian bond, and it's very comfortable doing that. Why is it comfortable doing that? Because the spread between Italian and German bunds is very, very stable below 120. Yes, we had this little tiny spike, but we came back very, very quickly. So the ECB seems to be in absolute control. So if this spread keeps on going down and it goes down to 100 over time, I just can't see how that is bad for bunds. It just shows that the market is buying the high yielder, getting the extra funding, and is very, very comfortable. Until this spread starts moving because people are afraid of higher yields and therefore want to dump everything, I just can't see that the Bund is going to start to move. So That is what I think about Europe. I think that it's very, very unlikely that we start getting big moves in Europe, and therefore I'm, more comfortable with not playing there because I don't see the point. In US versus Germany, I I was wrong about the speed that it would come down and continue down. I now think that until we get data from the US, this is unlikely to move very much. And the only way it can move back down to much lower levels is if data in late May or early June starts indicating that the US economy is in trouble. I think until then we stay around this 172 level and we don't move very much. So bunds and US 10s are going to be tied together to within a few basis points. It's going to be stable until the data tells us that we can go lower. I still think that eventually we go lower. I would much rather be long of US 10s because my view is that Europe has really done everything it needs to do for the time being, while the data can only get worse in the US. And if it does, it needs to be a big move, as I said, because the Fed is going to move by 50 plus very, very quickly. And I would expect them to do a total move of around 150 to 200 basis points and take Fed funds to zero real. So if inflation is 2.5, they would take Fed funds to 2.5. And that would give a lot of funding room to the banks to buy duration, because the banks will demand a very large spread, a very positive curve for them to buy duration. I just can't see who else is going to buy duration in the US, because it's not going to be foreigners, I don't think. It has to be the domestic banks and the hedge funds who then can just ride the curve. And for that to happen, there has to be a curve they can ride. And they are not going to ride a curve which is, a few basis points in funding. They need a very large spread against general collateral. General collateral now being at 433, and the 10-year, what are they picking up? Next to nothing. There needs to be a big rearrangement of the curve for them to really be enthusiastic about buying duration. And that is why I think eventually this goes down, but it's going to remain in this kind of range until we start getting the data showing the weakness in the US. The dollar is doing much as I thought it would. I think it's likely to remain in a range now between 98.80 and 140, or maybe go slightly higher to something like this, 101.92, and remain in this kind of range. I really think it's going to do much the same as it did here, i.e. spend another 3-4 weeks readjusting, and then when the data turns, that's when it goes. But in the meantime, just like I think the bonds are stuck, I think the US dollar is stuck, and it needs some time going sideways. And the main reason why I think that is because I think the yen got to exactly the level it should have done, 140.60, and it's bounced, and it can bounce some more, and I can definitely see it at 146. So that's a couple of percent. If this Euro Japanese yen stays roughly stable and keeps on bouncing off this 164.20 area or 165, that tells me that we're going to get maybe a couple of percent out of Euro FX. And if you look at this chart of the Euro, you're really looking for it to come back to around this 112 area of support. That could take, I don't know, a couple of weeks of going sideways like this down to these kind of levels, 111.60. That makes absolute sense to me. that we just wait here and do some kind of a bull flag, waiting for the data to turn, and we have another, I would thought, another 3 weeks of that before we can be comfortable and say that yes, the euro needs to be up at 118 to 120. But it really shouldn't be a US move, a euro move, because the euro is in trouble as well. It should be a move from all the other currencies that are in the dollar index, and least in the euro. So if we get another risk-off move, it should be the Swissy, it should be the yen, it should be the Asian currencies, and so on. So this, to me, is going to be a trading range between, just below 112, 111.50, and then 116 to 118. It's not going to be a humongous move in the euro, I don't think. The other currencies, I think, could go more. Eventually, I can see the yen, if it breaks these levels, going all the way down to, 125. So that is what I think for the next couple of weeks. It's back up to 146, stop a few people out, maybe go all the way to 147, 30, 50, and just after that we have the possibility of breaking down and saying that this is a massive head and shoulders and going all the way down into the 120s. It's going to take time. Gold, I think, finally shot its bolt at 35, in 35.60s, 34.60s, 34.70s. And it had the opportunity to come back because it was the day that basically the dollar bottomed. And with the bottoming of the dollar, gold came off. I think it can come off some more. Not huge, but this 3200 level, I think, is going to get tested. We were above the daily Bollingers, the weekly Bollingers, and the monthly Bollingers. You can see the monthly Bollinger is at 3211. Yes, we're coming towards the close of the month, but I think that we can definitely test those levels. I just don't think that gold can go now. I haven't thought that for a long time, to be fair. I've been wrong for a long time, but I think now gold has shot its bolt unless the dollar goes again now. And as I just showed you, I think that is very low odds. I think it's far more likely that we are in a trading range and that we correct and we do some kind of an ABC and stop people out than it is that we keep on going. There would need to be an event for gold to keep on going. So I have a few small call spreads on, which I'll dump on Monday, but my main position would be something like 3,200 puts to 3,000 put spread, because I think we can come down below 3,200 and stop people out, and that would be enough. That would be the equivalent of us being at 111, 111.50 in Euro USD, and that would be enough, I think, for the time being. We will have corrected all these daily and weekly overbought RSIs. If we just came back down into the 3100s, I think that would be enough. I haven't got much to say about GSG because I think it's going to be stuck for quite some time, waiting for that data about the economy. And maybe GSG is going to give us the clue in its trading over the next 2 or 3 weeks about which way it's going to break, either down or up. I certainly am not going to buy it unless I see at least 2 weekly closes above 22.93. It's possible that it starts filling some gaps. I mean, who cares? I'm not fundamentally going to be a buyer of it until it starts going well beyond 22.93. And I do want to buy it at 1970, 1980, because I think that it will have discounted a little bit of a recession. And I just don't think that we can have a recession without major easing. And that should be, good for commodities going forward. So I think that down here you buy it, up there you wait to see if it's breaking and then you buy it. I just can't sell commodities at such low levels when really we've had so much inflation since 2022 and we are at the same price as in 2022. That to me doesn't make much sense. What does make sense is that gold GSG is now correcting. And that is why I think gold can go a little bit further, because if GSG does nothing for the next 2 or 3 weeks and gold comes down and we get a correction to this kind of level, that's all we would need over a couple of weeks. That would give us gold in the 3100s, and that would probably be enough. So gun to head, if I had to hold something over the next 2 or 3 weeks, it would rather be GSG than gold. If we look at the clean chart, it's pretty obvious what is happening, and let's enlarge that for you. We've taken out 54.46, which indicates that, over time we need to trade 56.68 and then 56.68 and close this gap. I would be absolutely flabbergasted if this wasn't a great level to put on a put spread. Why would we get up there? Well, let's say that we do a mini operation twist in the QRA. That is good for all assets. The 30-year would drag up the equities, and maybe that is what the market was expecting. I don't think it's as likely as that, but I think these levels are going to be an absolute gift for put spreads. Because if I'm right and the economy does roll over, and the data shows it in late May, early June, that will have been a fantastic level to buy 2-month put spreads. And then we see what happens. But I just can't see that the equity market can keep on trading at 22 times very inflated forward earnings when the danger of the economy rolling over is so great. I know that we haven't had any strong data indicating that it is rolling over, and that is why I think the NFP this Friday is going to be the wrong data point to look at, because weekly claims have been, in line. So why should NFP be wildly out of line? It's low odds, right? But at that level, at 56.68, I think it's such a gift to be long of put spreads, because if you're wrong, you can't be far wrong. The one market that's been far stronger than SPX and the Dow is actually the NQ, which is up on the month. Now, what do I think happens here? I think the equivalent level in NQ, where it's a gift to do put spreads, is this 20,390. And if we try to match that, that is these highs here. And there's a gap actually around here. So 20,300, 20,500 is the area where you are supposed to just buy a 1 month, 2 month, 3 month put spread and see how it goes. I think it makes sense for NQ to be stronger than the SPX and the Dow. Why? Because I think the AI narrative is coming back, the technology narrative is coming back, and if the economy goes into rolls over into some kind of a recession, it's going to hit the traditional sectors of the economy far more than it's going to hit high tech. High tech is supported by the fact that it's the present and the future. So I think it's far more likely that high tech and high beta, because of the move that you'd get in the 10s and 30s down in yield, is going to be the thing that people buy as some kind of a refuge from the traditional stocks that are really affected by recessions. So this is ACWX, i.e. a bunch of international shares against the SPY, and I've marked here the 2nd of April. That is the level that I don't think that should go through, and this is ACWX over QQQ, and here I've marked the 2nd of April. And you can see how they're slightly different charts, how QQQ is much stronger than the SPY. And what I'm trying to suggest again here is SPY over QQQ, and April the 2nd is actually up here, right? So QQQ is doing much better than SPY since April the 2nd. What does that tell me? That tells me that you want to be in QQQ in the US and in ACWX and not SPY. So if you're running a fund or just a beta portfolio, you would want to swap your SPY holdings for QQQ and ACWX. And you do a butterfly. You're long half of ACWX, you're long half of QQQ, and you're short of SPY. That to me makes sense if you think that there will be some kind of a recession in the US, and that recession, as I've been saying, actually hits the traditional parts of the market far harder than it hits tech. And as I've been telling you for a couple of weeks, the risk reward becomes fantastic once we are here in volatility, 2060 to 2279. And there's a gap here down to 22 something, who cares? And when we feel that, I think we are in a fantastic risk reward position for return up towards 3011 and maybe even 33 or 34. So that would actually be the most fantastic place when you just shut your eyes and buy put spreads in the SPX. I've been asked to comment because some people on Twitter have been producing this chart, which is the trucking index. Right, what can one say about this? It is making new lows all the time, and it's not bouncing. And that would support the view that there is a complete halt to trade with China, and we don't really need any trucking to take containers from LA or from Miami or from wherever they are disembarked to the interior of the country where these goods get sold. It does suggest that, but does it, I've purposely given you a long-term chart going all the way back to 2016 to show you that it doesn't really mean that we are in an automatic recession. It means that we're not using trucks at the moment. And that's why I think that the odds are higher that the data will reflect this move, because let's face it, that's a big move from 1850 down to 1200. That's a lot of percentage points. Now, if this continues to fall over the course of the next 2 weeks, then I think the odds just keep on increasing that the hit to the data in late May, early June is going to be significant. And that would strengthen my belief that put spreads at the levels that I showed you, if we get there, are just a fantastic risk reward. But just because this has happened, I mean, let's face it, who is booking trucks at the moment? You have to be mad to be booking it. And therefore, the fact that prices are going down for those trips makes absolute sense. But per se, I don't think it does very much, apart from slightly move the needle and say that, yes, the odds are higher of a hit to the data in about 2 or 3 weeks' time. So to summarize, very little to do in the yield curve until we've seen the QRA. When we've seen the QRA, we will know that we can definitely flatten or not. Now, the flattening would, I presume, be strongest in the 2s, 20s, and having a small position long 20s, short 2s, i.e. long US M25, short the TU M25, if you want to play it that way, is the thing that makes the most sense, because all you can really expect him to do in that QRA is that slight operation twist, which has some justification. I wouldn't say it's got a lot of justification, but it has some. And if he wants to please Trump and bring down 10s and 30s, that's probably the way to do it, kind of thing, without people really going berserk about what have you done. So that is all I can think of. Otherwise, we will definitely react to the GDP data for Q1, which I think is going to be below 1%. And if that is the case, then the odds of Q2 data being negative, I think, increase quite a lot. So that is what I'm watching for next week. I don't think there's much to do in Europe at all. And I'm watching SPX and NDX, SPX much more than NDX. If we see the 56.68 area, or anywhere in between 55.68 and 56.68, you're definitely supposed to be doing put spreads, because the odds keep on getting better and better that you will get a weak data coming within 2-3 weeks. I've added BTC USD levels, and I will start doing a weekly chart on the BTC, because it's trading very interestingly against other assets, and we can certainly take some advantage. My main levels here, I do trade it quite often. 91,635, I'm definitely a buyer. Thank you very much indeed, and tweet you tomorrow.